Hi, this is Kevin, and today we're going to be talking about our launch of dimensional funds, DFA funds, and the reason why we're going to be adding them to the group of funds that we already use. And you're going to see some changes in portfolios adding dimensional funds because we really feel like they're going to give us a more systematic approach to getting the dimensions that drive market returns. So the first premium that we know about, when I say premium, just that you're going to make more money over long periods of time probably, is the premium, the equity premium. And this is so well known now that most investors that invest in stocks or equities invest in them because they think they're going to make more money. Why would you invest in an asset that can go up and down a lot more? Now, this equity premium, for our purposes of leading edge financial planning, we look at this as a group of stocks, large group of stocks. We don't really like the individual stock. Yes, you can become a rich man, and yes, you can become a poor woman, or a rich woman and a poor man, because investing in one stock or even multiple stocks can cause major losses. But over long periods of time, the stock premium has been there. The next three are really something that Nobel Prize winners have worked on, and it's probably about 30 years ago when they started publishing a tremendous amount of data on these two. It was called originally the three-factor model: one market, two company size, and three value premium. So if you look at small, obviously there's the largest 500 companies in America, the S&P 500. Actually, companies over long periods of time that have been smaller have had a higher return. And so we call it an expected return in the future because you can never know for sure if things will continue to show up. But there's been, and I'll show you the data through the different countries of why this seems to be pervasive across all markets. The other thing is buy companies on price, okay? Buy them on sale, I should say, not on price. Buy them on sale. If you go get a dinner at a fantastic restaurant and you pay 4 times more than what others paid for the same dinner, you're buying it at a really bad price. And so what we're saying here is that there's companies that are out there that are on sale. Now, how do you know if a stock is about to go bankrupt versus a stock is on sale? Well, we're not going to buy individual companies. We're going to buy markets of companies that are have a relative price, and the relative price that Dimensional uses is price to book, which is the price of the stock versus the book value of the company. And they try to they get all the companies that are more value oriented, where they all appear to be on sale, and they tilt their portfolios that way. That doesn't mean we're not going to own growth companies and growth markets. We're just going to tilt towards these premiums as opposed to say, let's just put everything in the smallest and most value companies, because then there's going to be times where you may want to give up. And then the other fourth factor or fourth dimension of return is profitability. And so would you rather own a really profitable value company, so a company that's on sale that's really profitable? Would you rather own that, or a company that's on sale and has no profitability? So within the small and the value, they look for more profitable companies. Even within the growth, they look for more profitable companies. Now, this is not a market decision or a stock picking decision or a timing decision. This is owning all the companies that are within this value parameter of a price to book that's relatively low compared to other stocks. And the profitability is the same thing. They're not going to own a tremendous amount of Apple if Apple price to book is 40 times and the profitability of Apple is no longer as profitable as it used to be. They're going to own some of it, but just not a lot of it. They're going to tilt it towards the other items. The evidence continues here with the dimensions of return we just talked about. Okay, so we all, I think, accept that stocks have a higher expected return than bonds. So all we're going to look at here is the company size dimension, relative price, which again is value, and then profitability. So in the U.S., United States, since 1928, when you look at small versus large, which means, and I'll show you another graph of this, but small has beaten large over that whole time period by 2.28%, or a 12% return versus a 9.72% return. So you say, well, maybe this is just the data in the U.S. Let's look at the developed. And the data set you'll see is only from 1970. These guys that did this work, and this is the CRSP data set that French actually has worked on, FAMA in French. It's really, I think it's pretty well accepted that it's good data. But anyway, small versus large in the developed world, which is foreign companies but developed, has been a 14.48 versus 9.45. So small companies internationally that are in developed markets have done even better. Emerging markets, you say, well, emerging markets, probably the larger companies would do well because they're more well known. It's turned out to be the exact same way. So small does better than large. Now we still want to own large, because if we don't, when small does much worse than large, and I'll show you those time periods, we're not going to be happy. Relative price, value. So since 1928 to 2015, value companies, and by the way, this is what Warren Buffett invests in. He tries to find companies on sale. What DFA says is own them all. Just own all the companies that appear to be on sale. Some will go bankrupt, and some will do tremendously well because they're on sale. Value beat growth 3.44% on an annualized basis. Developed. I don't know why, but once again, it's even more striking. Buying the non-sexy companies that seem to be on sale, that everyone doesn't love, appears, at least in the past, we can't say in the future, but to cream it. And then again with emerging markets, data's through 1989 to 2015, same thing. Profitability. So we take the most profitable companies within these other subsets and we tilt the portfolio towards profitability, and here's the evidence. 4.35% return with the most profitable companies versus the least profitable. Same in developed, same in the world. Pretty striking. Now, I said in the other video that we're trying to improve the process of investing, but we are still going to have times when we're disappointed with our results. And so this is the stock premium versus the Treasury bills. So this is the fact that stocks do better than bonds over long periods of time. But look at the areas of red. These are the areas that are the reason why we all don't just invest in stocks. These are the reasons, the red. So there are periods of time where you have to sit on your hands or be disciplined or do nothing or just sit there, whatever the terminology may be. If you want higher expected returns and there's no way to get out before the crash and get back in before it goes back up, then you have to sit on your hands. And that's the reason why you really want to focus with us to make sure that you have an asset allocation that has the right amount of stocks, bonds, and cash. Large cap versus growth. There's been periods, look at the last 2 years, where small has done worse than large. So once again, you have to be willing, if you're going to tilt your portfolio a little bit towards small, to understand that there will be times you'll ask, why are we doing this? But overall, I showed you here the big difference in returns over long periods of time. Okay, value. Companies that are on sale, buy them all. Buy them all. Don't just buy the ones like Warren Buffett does, because it's too hard to do. But there's been times when value's in the red. And look at the last 1, 2, 3, 4, 5, 6, 7 out of the last 9 years. Growth has beaten value. Warren Buffett's return over the last 12 months is negative 12%. That has to do with value falling out of favor. Now, will value come back in favor? Well, we'll have to see. But it's been pretty persistent in all markets around the world since the data started. And so we can tilt our portfolios a little bit towards value. And then profitability. And you can see there's been times when less profitable companies did well. The dot-com bust. These companies were not profitable. This is developed markets. This is foreign markets. Same exact stuff. There are times when you won't be happy that you tilt your portfolios or have more of these dimensions of return. Profitability has not been a big issue, though, worldwide. Emerging market is the weakest data set. It is, because it's only through 1989, but same people that have done all these other data sets that are always quoted in papers and on shows. Stocks have done better than bonds. Small, pretty consistently have done better. Value versus growth. This has been a tremendous disappointment. Now, in the last 2 years, it could be oil, but the other years, it's not. So we'll have to see. Things continue to happen until they stop. And then profitability. The last subset of data. Here's the returns of stocks, U.S. stock market. Returns are somewhere around 8.6 for this time frame. The amazing part is how few returns actually showed up to be at 8.6. Most of them were down, or most of them were high, and most of the time when you've had major downturns, you've had rebounds. So if you're going to own stocks, have that part of your portfolio. Just don't worry about it. When it goes down, it's going to happen. It's expected to happen. Small versus large. The premium is 4.11 greater. And when I said 8.06, that was the premium, I'm sorry, of stocks over bonds. It wasn't what the return was. The return was a little bit higher. We can see again that the small premium, the dimension of smaller companies, hasn't always worked, and sometimes it's not worked well at all. Value versus growth. Paper was just written, is the value premium dead? Anytime you hear something is dead, usually it goes the other way, but I don't want to time the market. Can you believe that last year, 2015, less profitable companies did better than more profitable companies? Crazy. Crazy. Last 5 years, a lot of the investing has been based on probably momentum and excitement to own companies that are going up. And so, very amazing. So beginning with the end in mind and summarizing, really what we want to do is pursue a better investment experience using all this evidence. So this is not an easy process for clients to understand, and it's not an easy process for many financial people to understand. We always want to think there's a better mousetrap or a better way to invest than the way of having to deal with the downturns in markets. So this investment experience only works if we all stay together and believe in the experience, believe in the evidence, I should say. So at the end of the day, it's all about our behavior and can we stick with it. But anyway, on behalf of Charlie Mattingly and myself, Kevin Gormley, thank you for watching Leading Edge Financial Planning's Investment Philosophy.